how's it going? What a shift to go from the 25-hour week of Goldman Sachs down to the cushy job as a professor at one of our acclaimed schools. How abrupt has the shift been?
Well, it's 25 hours a day, not a week.
Excuse me, correct.
That's quite all right. It has been a wonderful adjustment for me, frankly. You know, I was an adjunct at Columbia for almost a decade, so I knew what I was getting into. I love the students at Columbia. Half of them are from overseas, and it's a terrific faculty. And I'm spending time with a lot of the faculty working on new curriculum materials for them, incorporating the real world aspects into the academic work.
And the foundation here, folks, is something that's a rite of passage if you're in the racket. You must read either 1934 Graham Dodd, or maybe you catch up with Graham Dodd and Cottle. Right now, we look at Graham Dodd and Joseph Cohen, which is going to be the new definitive book out of Columbia Business School. How do you take the fundamentals that we were weaned on and drag them forward into Jerome Powell's modern age?
Tom, that is a wonderful question, but first let me set the stage. And that is to say, for the last few years, the fundamentals have mattered less than things like momentum and investor enthusiasm. You know, you take a look, for example, at the strong correlation between the technology stocks, cryptocurrency, and so on, and basically say these are types of financial assets in which valuation approaches really didn't matter very much. And I think we're now back into a period in which it does matter, where it's the fundamentals of earnings, the fundamentals of margins, the fundamentals of inflation and interest rates, and putting that all together in terms of appropriate valuation models that will make a big difference for investors going forward.
Abby, how do you model the fundamentals at a time when people can't game out whether we're going to have a sanguine economy or a hard landing that looks something like a depression? At what point do you game out recessionary outcomes in your fundamental analysis?
Yeah, you know, there are two different ways to look at that, Lisa. First of all, we can game out alternative scenarios. So we have some sense of what the range of possibilities might be, not just for equities, but other financial assets. But of course, at the end of the day, an investor or portfolio manager has to say, what do I think is the most likely scenario? You can always plan for the worst if you have very little risk tolerance. You can always plan for the best if you're highly risk averse. But I think many portfolio managers are aiming for something in the middle where they're trying to identify what is the most likely scenario.
Right.
And as some of your earlier guests indicated, what seems to be priced in right now is a mild recession, certainly not a severe recession.
When you look at the parameters, do you look at the end of the era of free money, or do you look at just simply a pause, a momentary reprieve from the ultra-low rates of more than a decade as we try to curtail inflation, and then a reversion back to that at the end?
Yeah, let me adjust the question just a little bit, Lisa, and to say that money isn't free anymore, but in many cases, it's not particularly expensive, particularly by historical standards. And so while we have seen this rise in interest rates and the Fed is likely to continue to move those short rates higher, we've already seen quite an increase in the intermediates and the longs and the rates that affect consumers, for example, through mortgages. And so what we have to recognize is that when money becomes more expensive, in some ways, investors, households become much more careful with it because if it's no longer free, you're going to see less leverage, which is a good thing in portfolios. For example, we've had incredible returns in some private equity portfolios. Maybe the basic returns were good, but in some cases they've been turbocharged by significant amounts of leverage, which sort of hide the underlying skill set, if you will, of the portfolio manager. And then, of course, there are many corporations that took advantage of very inexpensive money to leverage up their results. And so when money is no longer free, we get to see a better picture of whether those corporate managers and those portfolio managers are actually doing a good job.
Well, Abby, you talk about how people are more careful with their money in this kind of environment. And we know that it wasn't just, corporations and big institutional investors that were moving money around during the pandemic free money area. You also had stimulus that was fueling the retail investor, and they have been a force within these markets. What happens when that goes away?
What we are looking at, of course, is a situation in which individuals, in many cases, became overly enthusiastic about some areas of the market, equities and elsewhere, including digital currencies, that offered good momentum. And what we are moving into and have already begun to see is what happens when the momentum breaks down and you need to start looking at the valuations per se. Now, individual investors, of course, have many different factors that they need to be concerned about. Some of it has to do with how much longer they have in their investment horizon, what else they might need the capital for, and so on.
Right.
And so we may, in fact, see less money, and we have already seen this, going into things like cap-weighted ETFs. We've not yet seen the intermediate aspect, and I don't think it's going to be all that bad, frankly. Just looking at the demographic.
I say this in great honor of your 2005 paper, which is definitive, folks. It's basically codified within the CFA Institute. Aristotle on investment decision-making. We have dragged ourselves, Professor, from the elegance of 2005 to a 2022 discussion of what's called a cathartic puke. How does catharsis play into fundamental analysis and the confidence to own equities? Do I need to go down substantially to find a base to own equities?
We are now, I believe, Tom, in a situation where beta will be less important than alpha. And that
Explain that, please. That's really important. Explain that.
Investors always think that they are smart in a bull market, right? So if you're invested in a bull market, almost anywhere in a bull market, the beta of the market, and that has to do just with slopes of lines and so on. Don't confuse basically a bull market for genius. And so that's beta. Alpha is security selection. And one of the curious things about the last 2 to 3 years in particular is that it's been really hard to get alpha. So investors, professionals who've used sophisticated approaches, trying to identify what particular securities they wanted to invest in, often stumbled because alpha didn't matter very much. With this dramatic reset in the markets, the overall decline, number one, number two, the breakdown of the momentum orientation, and number three, the recognition that the economic cycle itself is shifting. We see a move now, I believe, toward alpha, and that's not just within the U.S. equity market. It's likely to happen in other developed markets as well. Yeah. And also think of it more broadly in terms of asset categories that are no longer all going to be moving in lockstep.
Well, that's exactly where I wanted to go, Abby, and we just have about a minute left. Does this mean that it's the end of the sort of standard 60-40 in terms of just working and needing a more nuanced, scalpeled approach, even with asset allocation?
Let's recognize that 30-year plus period in which inflation and interest rates were under good control and continue to move lower is over. That doesn't mean that a year or two from now, inflation will be under incredible uncontrol and interest rates still dramatically rising. I don't expect that. But we are exiting that 30-year period in which fixed income securities were a very good place to be invested. And that 40% rule right now may not be such a clever thing. One other point, if I may, that Aristotle paper talks about the importance of understanding the data. Let me give you one example right now. There's so much focus on headline CPI. You guys have done a great job of contrasting headline CPI to core CPI. What the Fed is looking at is the better measure, which is core PCE, which is running 3 to 4 percentage points below the headline CPI. So rather than looking at like an 8% number, they're looking at a number which is 5% and maybe even a little bit lower. It's still a rise in inflation. I don't mean to suggest not, but it is not
Right.
quite as awful looking as the headlines would suggest.